Welcome back to the Editors Roundtable on CNBC-TV18. Now, the big headline, of course, was the massive fall that we saw in the Adani Group stocks. But let me bring in Ritu Singh, who has the exclusive response from State Bank of India on the Adani stock rout on the back of the Hindenburg report. The bank has said that SBI's exposure to Adani Group is well below the large exposure framework of the RBI. Ritu has more on that. Ritu, over to you.
Well, that's right, Sonia. SBI, one of the largest lenders to Adani Group, has just told us, and I'm quoting this verbatim from the managing director in charge of corporate accounts at State Bank of India, who I just spoke with, who said, the group exposure of Adani Group is well within the large exposure framework limits, which is 25% of the bank's Tier 1 capital. Secondly, all of the exposure of SBI is secured by cash-generating assets, and any acquisitions that the Adani Group may have been making is largely from overseas market borrowing. So there is very little exposure as far as the Indian banks are concerned. Secondly, and more importantly, the bank highlighted that the Indian bank's exposure to Adani Group has been declining over the past 2 to 3 years, and that is a trend that we've been seeing as well. And at the same time, their debt to EBITDA has been improving as well, which improves their debt service obligations as well. As is known, there is the exposure build up to the Indian banking system on this account, therefore, has been low. SBI also, in the meantime, keeps reviewing the exposure to check whether there is the likelihood of any stress build-up over the next 12 months. And from those tests, SBI has been able to tell us that there is no concern on devolvement of Adani Group loans. And if any action is required, they will take time, measures from time to time to ensure that their exposure is safe. And as of now, no concern whatsoever on their exposure to the Adani Group.
All right, Ritu, thanks very much for that. That's an important story which we will continue to track. Gautam Dugat, of course, is still with us. Gautam, away from all of this, earnings are coming through, and you mentioned a little bit about the kind of earnings we're getting. I wanted your thoughts on Dixon, which is, of course, well-tracked, institutionally owned stock. Big cut after the earnings disappointment. A view on the stock, and what do these earnings tell us about, the overall sort of optimism about manufacturing in India, because that was the poster boy, right?
Yeah, so see, Dixon we don't cover yet. I've seen the earnings. I think they've lowered the guidance. I think the market reacted more to that, because I remember at the beginning of the year, their guidance was 18,000 crores of revenue. And then it was brought down to 14,500. And I think now it is somewhere about 12,500. Particularly the mobile and consumer electronics segment is where they've seen a lot of downside. And obviously stocks we've seen across sectors, wherever the PEs are high and growth is not coming through, they're getting punished. So this was one more addition to that list. That aside, if you check through the other consumption results also, I think barring Hindustan Lever and some of the auto sector companies which have posted good set of numbers, almost every single consumer company, especially on staples as well as on discretionary, whoever has posted the result, they have disappointed on demand. Companies are reporting single-digit top-line growth for 4, 5 quarters consecutive basis. We've seen earnings cut of 10-12%. Big names which have seen earnings decline for 4, 5 quarters in a row. So maybe we are living through a consumption slowdown period right now, which has been ongoing for last 2, 3 quarters, exacerbated by what has happened in the rural India for last, 8, 9 months. Urban, we had seen a big pent-up after 2 years of pandemic in CY22. So this year, urban should normalize, and that's why the hope from the budget is that the government will put some money in the hands of bottom of the pyramid population, because this year you are talking about 8 very important state elections, which then culminates into 2024 large one. And this will be the last budget, full-fledged budget of this government. So that is where I think a budget comes very handy. But that aside, high PE stocks where growth is not getting delivered, guidances are getting cut, there is a clear reaction from the market. And Dixon falls into that category.
Absolutely. Well, let's move on then. A SEBI study has revealed that 89% of traders in F&O lose money. The other way to look at it is 11% make money, which is higher than the strike rate in IIT entrance exams. So, and if you want to look at things positively, but Prashant, you have all the details, right?
I do. We're hearing from all finfluencers and all kinds of influencers that trading is the way to go, right? And I think the SEBI report gives us a reality check that it is not easy. Let me just go across to the wall and tell you what exactly the report says. So let me tell you what the scope of the report is. I'm calling it, does Satta make money, right? And this is, of course, from no less than SEBI, the market regulator. This is a 33-page report. They've analyzed P&L of individual traders. So this kind of excludes institutional traders, you know, prop books, etc. So this is individual traders. They've only looked at the F&O segment, and this is only for 2 years. FY19 and FY22. One is pre-COVID year. The other is, I mean, FY22 means this is bulk of the year was 2021 calendar. This was, of course, still lockdown, Delta wave, etc. So people were stuck at home. I'll tell you why that is important. And they studied data from 10 brokers, which made up 67% of the individual client level turnover during FY22. So this is not 100% data. This represents 67% of the individual client level data. First is the number of individual traders, which has seen a big explosion. It was 7 lakh odd in FY19. In FY22, it went up to 45.2 lakh. And this is what I was talking about. 2021 was a COVID year, and trading volumes, not just in India, but around the world, zoomed up because people were stuck at home, could not step out. And I mean, you know, trading was one of the things which they engaged in. Age profile of traders also kind of has just shifted. So between 20 and 40 age group, you know, in FY19, it made up for about 54% of the volumes, 55% of the volumes. That's moved up to almost 75% of the volumes in FY22, right? Naturally, I mean, people who were going out to offices, they were stuck at home, and they also engaged in a fair bit of trading. Now we come to the statistic, which is basically the headline of this piece. This is their study in terms of how many people made money and how many lost. Simply put, 89% of those who traded lost money, and 11% actually were able to make a profit. What was the average profit and average loss? The average loss was 1.1 lakh, and the average profit was about 1.5 odd lakhs as well. Just a stunning statistics. The SEBI, the study says the average loss of a loss maker was over 15 times the average profit of a profit maker. I mean, I thought that was kind of interesting to put out. What is the sort of trading activity in options versus futures? The next graphic will tell you 98% of the volume is now options. Futures 11%. It's not very different from FY19. But if you go back 10 years, I mean, you go back to 2007, 2008, you know, it used to be reverse. 11% options, 90% futures. That's completely flipped. But of course, that's a slightly longer time period we're looking at. Transaction costs, I mean, something which people don't consider. And the SEBI studies says traders paid, you know, loss makers paid 23% of their net trading loss in transaction costs, and the similar numbers out there on the profit-making side as well. So these are substantial transaction costs. I just want to end with a couple of points, which I think should be pretty obvious looking at the SEBI study. Making living by trading is, I mean, it's actually one of the toughest things out there. Don't let what people on social media, etc., tell you. It is tough if you're looking to run your house by the trading income. Successful trading requires study, dedication, method, system, whichever works for you. It is not random. It is never random. And of course, a lot of it is mental and behavioral, right? I mean, it requires you to overcome one's own biases in a very large way, inherent biases and traits. I want to just end with what I think one of the greatest ever traders has said. Ed Sykota is featured in the Market Wizards book. It's a book which you should read if you are planning getting into trading, or if you've not read. He says it can be very expensive to try to convince the markets that you're right. And second, he says the elements of good trading are 1, cutting losses, 2, cutting losses, 3, cutting losses. If you follow these rules, you may have a chance to survive. I think, I mean, pretty wise words from someone who's actually thought about this stuff in a pretty deep way. So that's a SEBI study for you. Back to you guys.
Absolutely. You know, and just one last point. The study also says that the top 1% make 50% of the overall pool of profit, and top 5 or 6% make 91%, which takes me back to the old classic of Ashok Kumar and Amol Palekar, Choti Si Baat, where he says that the bottom is always crowded, there's always space at the top. Of course, only 1% managed to reach the top, but if you do reach the top, then a lot of money is to be made there as well. And you know who's making all these monies, by the way? There's
not as for sure.
The HFTs, the high frequency trading firms.
Yeah.
You know, our colleague Santosh Nair had made this beautiful report. The high frequency trading firms are making money hand over fist, right?
I just feel bad for that guy who,
Because
you
you
know,
take emotion out.
no, I just feel bad for that guy who must have, you know, during the pandemic, maybe lost his job, as you said, and started trading and then made all the losses. So
Oh dear.
poor guy. Okay, well, folks, no, it's important. I mean, jokes apart, it's important to take all these this caution on board. But hope you guys have a great, restful weekend. With that, we wrap up with this edition of Editors Roundtable. We'll see you again on Monday.